The fear of a further spike in inflation has compelled the Monetary Policy Committee of the Central Bank of Nigeria to adopt a tightening stance by raising the cash reserve ratio for banks in the country from 22.5% to a new level of 27.5%. Central Bank Governor Godwin Emefiel says the move will mop up excess liquidity in the Nigerian economy and check rising inflation, which has been on an upward trajectory since August last year. Here's CGTN's Deji Badmus with more on that.
With Nigeria's inflation on a steady rise over the past 4 months, something needed to be done to check it before it spiraled out of control. And that's exactly what the Monetary Policy Committee did, responding by jacking up the cash reserve ratio from 22.5% to 27.5%. Nigeria's current inflation rate is at 11.98%, partly blamed on insecurity in some parts of the country and the closure of the country's border.
Monetary policy felt compelled that we need to begin to look at what can be done to reverse the trend of this rising level of inflation and prices. And hence, the committee felt in its wisdom that realizing that there's a lot of liquidity in the market, there was a need for the bank to do something to mop the excess liquidity to a level that it considers optimal to be able to run the economy in a way that the level of excess liquidity does not become injurious to the economy.
Last year, Nigeria's Central Bank raised the loan-to-deposit ratio for commercial banks to 65%. Some fear the MPC decision to raise the CRR and mop up liquidity in the banking system could have a negative consequence on commercial banks' ability to lend and thereby defeat the whole essence of the LDR initiative.
Deposit money banks must be compelled, like we are using prudentials, to ensure that they continue to grant loans to the private sector of the economy. And committee felt that, yes, whereas we are trying to remove the excess liquidity from the market so as to operate within an optimal level of liquidity that is needed for the economy, that the CBN should continue to push on the loan deposit ratio since that was already giving us the kind of results that we expect.
With Nigeria's reserve dwindling in recent months and inflow of foreign capital slowing down, some analysts had been forecasting a possible currency devaluation at some point this year. But the CBN governor is resolute that there's nothing like that in the offing.
A reserve level of about 38 today, right? And crude price at above 57, 60, 65, sometimes hit 70. We believe that we will be able, and we are saying that we should continue to sustain the existing FX, foreign exchange management and stability that we've seen in the market. There's no need for anybody to ever think that an adjustment would happen.
Everything hinges on the price of crude. Should there be a sudden crash in price below the budget benchmark of $57, then devaluation might become inevitable. But the Monetary Policy Committee also warned that the country needs to check its rising debt level and look at other ways of raising revenue to drive the economy. Deji, CGTN, Lagos, Nigeria.